I think that we have enough worries to deal with right now, but we also have some areas where things are improving. So let's first take stock of the three key areas of worry that you talked about: rising interest rates, inflation, China slowdown, and the war. But also let's make sure that we focus on some of the positives that's out there. So clearly the war in Ukraine has been a major shock to the geopolitical order, and it has spilled over into energy security and also on food security for many countries in the world. And there is not much sign that this will all get resolved anytime soon. So we have to be prepared for these disruptions on energy and food to continue. And therein lies the question of nationalism. Many countries, somewhat justifiably worried about all these uncertainties, are turning inward. We have seen decisions to ban wheat and sugar and palm oil in various parts of the world, and that has created even additional concerns, which have direct impact on the well-being on the average citizen, because at the end of the day, food prices are something that we deal with every day. I think that there is sufficient supply for bulk food commodities out there in the world, whether it is rice or wheat or coffee. I don't think we are in the middle of a major supply crisis. It's more of a distributional problem. That in some places there's a lot of food commodities, it's just not making its way to the rest of the world. Ukraine being a key producer of wheat, for example. There's a lot of wheat in Ukraine, but getting it out of Ukraine is problematic. So one would hope that as the international community comes together, there are ways we can figure out to improve the distributional aspect of food supply, because as far as the overall stock of food is concerned, we actually don't have any shortages. And we also hope that there won't be too much manifestation of this nationalism fervor that we're seeing through various export bans. That is, of course, very dangerous for food security around the world. As far as interest rates and inflation beyond the war in Ukraine is concerned, that is also a challenge for emerging markets. Over the last 30, 40 years, we have seen every time the US has raised interest rates, it has caused volatility in global markets, put pressure on emerging market currencies, created capital flow volatility, and that makes it difficult for economies that rely on global capital flow, whose interest rates follow global interest rate trends. It becomes a bit challenging. But it is not something that we should be too concerned about, because unlike the previous episodes when interest rate increases created a lot of problems in Asia, Asian economies by and large have higher foreign exchange reserves, lower current account deficit, and therefore the ability to deal with tougher times with respect to higher interest rates or capital flow volatility is very much there. So challenge, yes, but the buffers to deal with the challenge, also yes. Now, in terms of issues beyond that, I think we should be also clear in our understanding that things are not just dark. It's not just shadows. There's also pockets of light. Exports, for example, so far out of Asia, whether you are a commodity exporter or an electronics exporter, demand is pretty good. Opening of economies. 2021, virtually no tourism in the region. 2022, there will be quite a bit more tourism. Maybe not as many Chinese tourists as we hope for, maybe very few Russian tourists, but intra-ASEAN tourism, tourism from rest of Asia, from Western Europe, from the US, I think there's substantial upside. So I think tourism and exports are two possible bright spots for the region this year. And also pandemic management. I think from a year ago to today, vaccination rates, treatment for those who actually get COVID, we are in a far better position. And therefore, we can live with COVID now, even if there were going to be another variant coming up. I think we are now far better prepared to deal with that. We will not cause lockdowns and shut our economies down. So we can live with COVID. We have good prospect for exports and good prospect for tourism. So these are the reasons I'm still constructive about the outlook. So in a way, Sri Lanka's narrative is a cautionary tale for emerging market policymakers. If you don't have good macroeconomic fundamentals in place, the moment there is a storm in the global financial environment, you'll get hit. So Sri Lanka came to 2022 with very weak fundamentals. Their reserve position was weak, their imports were too high, and as a result, the moment oil prices went up, food prices went up, the balance of payments of Sri Lanka became unsustainable. When I scan Southeast Asia, I don't see similar risks. I feel that, again, reserves are high, balance of payments are not that weak. So the ability to deal with the shock, whether it is high interest rates or high food price or high fuel price, is ample. So Sri Lanka is a very unfortunate case, but I don't think that case will be repeated in this part of the world.
Okay, including Indonesia?
Absolutely. So there will always be no vacuum. We don't, live in isolation. So what happens in the rest of the world will affect us. So we cannot remain insulated from increase in fuel prices. We cannot remain insulated from increase in food prices. So clearly, the higher inflation will cause difficulty for the average Indonesian. They will be spending more money on a day-to-day basis. That higher inflation may also cause Bank Indonesia to increase interest rates, which may make it difficult for companies. So when I say that the buffers to deal with the crisis is substantial, I don't mean that it will be painless. There will be some pain, but the pain can be managed because the country's fundamentals are better now. So I can understand the lack of urgency on the part of Bank Indonesia. Some fuel prices are subsidized. We don't have any major food problems so far in Indonesia. And overall, environment, despite interest rates going up in the US, that has not manifested into major rupiah volatility. And the reason for that is, of course, the commodity side of the economy. Indonesia exports a lot of commodities. High commodity prices help Indonesia. So it's a two sides of the coin. On one side of the coin, you have higher fuel prices causing questions about subsidy, maybe some interest rate adjustment. But on the other side of the coin, you have higher commodity prices, meaning non-tax revenues are going up, the budget is getting balanced as a result. So for a country like Indonesia, which has some exposure to the global food price, fuel price issue, but at the same time some offset because it exports coal and gas and oil, it's not in as great a danger as a country that has full exposure to the import part. No export offset, because most countries in Asia don't produce commodities, they import commodities. So from that perspective, Indonesia is more insulated than a country that has to only import energy. So I can understand from a monetary policy perspective that sooner or later interest rates will have to go up. but there is not as much urgency as it is elsewhere, where the upside to inflation is far greater and the risk to the balance of payments is far greater. So when we analyze the outlook of regional economies, we find that on a historical basis, Indonesia's economy is less reliant on what is happening in, say, the US or China. Indonesia's economic outlook is largely driven by domestic factors. So right now, we have a difficult external environment. Growth in the US will probably slow in the second half of this year. In China, we have already seen substantial slowdown. These are major negative factors for many countries in Asia, but not necessarily a very major negative factor for Indonesia. Because Indonesia's 4.5, 4.8% growth outlook for this year is not necessarily reliant on what's happening in America or China. It's more about the domestic economy coming out of COVID. It's about the domestic economy finally seeing some tourist flows. And those things are not necessarily going to be affected that much by what's happening in the US and China. Again, it's a problem for many countries in Asia, but less of a problem for Indonesia. I think the risk of a substantially slower economic growth and substantially higher inflation, that mix is far less likely in Indonesia. I think there are many other countries in Asia I would worry about that. Indonesia will not be at the top of my list. The debt GDP ratio of Indonesia by international comparison is very low. When you think about the US, almost 100% of GDP. When you think about India, 70% of GDP. Indonesia is not even 40% of GDP. So since the 1997-98 financial crisis, Indonesia has been very conservative in terms of public sector borrowing, in terms of fiscal deficit. Which country do you see in the region where anything above 2% of GDP is considered bad? You know, most countries run 4, 5, 6, 7% of GDP deficit. So from that perspective, Indonesia's annual deficit or the stock of debt is much, much lower than peer countries, both in Asia and elsewhere. So when global investors look at Indonesia, they seldom worry about Indonesia's public sector debt profile. Now, of course, that doesn't mean that there is no worry. If the deficit is rising, if the debt ratio is rising sharply, then you worry. But given what we have gone through in the last 2 years, where you had countries that ran 10, 15% of GDP deficit, let their debt GDP ratio go up by 20% just in the span of 2 years, compared to that, Indonesia has done very little, which also then tells me that going into 2022 and beyond, there are many countries in the world, we will worry about their fiscal deficit and fiscal stock of debt. Indonesia will not be one of them. My favorite example for comparisons with Indonesia is Brazil. Populations pretty similar. Both countries, very large geographic footprint, massive amount of natural resources, but at the same time, not a beyond commodities, not a big beneficiary of exporting, say, electronics or being part of the global supply chain and so on. Although Brazil has a bigger automotive and engineering industry that is export-oriented than Indonesia. But still there are lots of similarities, demographics, commodity, rich background and so on. So I think the key lessons out of Brazil's experience over the last 100 years for Indonesia is don't rely too much on commodity exports because it's very volatile. So sometimes you'll do very well and sometimes you'll do very poorly. Number two, don't let the role of the public sector become so big that it crowds out private sector. Brazil, the role of government is very large. It collects 30% of GDP in revenues. It spends a lot, but as a result, the public sector sort of sucks out the oxygen from the private sector. It has a dynamic private sector, but it could be far more successful if the government's role in the economy was less. In the case of Indonesia, the government plays some role in the overall economy, but nothing compared to what the Brazilians do. So I think those are the two major things. Don't rely on commodities too much, and don't let the government crowd out the private sector. You see, at the end of the day, what do people want from the government? They want the government to give them security, whether it is law and order security, or energy security, or food security. They don't want to go to a petrol pump and see no petrol. They don't want to go to a grocery store and see no food. They want a supply chain, whether it is managed by the government or the private sector, they don't care. They just want security for food and energy. Now, if it turns out that the private sector is falling short in providing this security to the population, then there's a role for the government to fix that market failure. It can be done through public procurement. It can be done through public ownership of critical parts of the supply chain, or it can be done through institutional reform so that the private sector has the wherewithal, the regulatory environment to provide those services to the population without the government being involved. But either way, you need intervention, either in governance or in policy or in institutions, or just direct government involvement in managing the supply chain, in providing energy and food security to the population. So I think from a political economy perspective, that is a core responsibility of the public sector, to provide the essential goods and services to the population, whether it is through government intervention or through government nudges to make sure that the private sector can do that. I think the sign of a mature democracy is the political cycle has less and less relevance for the economic cycle. So it doesn't matter who the president is today and in 2024, the direction of reform, direction of the economy is independent of that. And I think we can safely say that over the last 10 to 20 years, Indonesia has shown that propensity, which is we have presidential elections, we have presidential transition, but the overall direction of the economy remains largely unaffected by that. See, you don't want what happens, for example, in the US, where the two parties represent very different economic ideologies. So one party comes to power, they undo all the things that the previous party did, and then they leave power, and the other party comes and they undo what these guys are doing. So I think that makes the economic cycle and political cycle too reliant on each other and creates uncertainty for investors, create uncertainty for the economic outlook. So I like the fact that whether it is fuel subsidy or the role of state-owned enterprises in the economy, or the policies on tourism or manufacturing or mega projects, there has been no major change or backtracking of policy in Indonesia, independent of the political cycle. So I think my only expectation, and to some extent prediction, is that even the 24 election in Indonesia will not lead to a major change in the direction of reform or the consensus on key economic policy. That's why I don't worry too much about the election. Two decades ago, the US had what we call the dot-com bubble burst. And billions of dollars of market valuations were wiped out. A lot of investments went bad. People lost jobs. Companies went bankrupt and so on. But within 2 years, the sector came roaring back. And by the end of that decade, tech was as important and as relevant for the US economy as it was before the dot-com bubble burst. So that experience tells us that the digital aspect of the economy is a secular force. You may have cyclical volatility, just like what we're having right now. Maybe the valuations were too high. Maybe the Fed interest rate increase creates major headwind for growth companies, and there'll be some layoffs and so on. But that has absolutely nothing to do with the secular structural direction of the digital economy. That is clear. That is here to stay for the rest of our lives and beyond. That is not turning around. There could be, just like a year has seasons like winter and summer and rainy season, There might be a bit of a winter in terms of capital raising. There may be a bit of a winter in terms of hiring, but that will pass. And the companies that provide genuine value to the economy, to the population through the digital means, they will continue doing very, very well. I have no doubt in my mind.
Okay. Thank you, Mr. Baig.